All right, let's talk about a classic puzzle that every business has to solve. You've got two different investment options, but you can only choose one. How on earth do you figure out which project is actually going to make you more money in the long run? Well, today, we're going to break it all down.
First up, we're going to set the stage with a classic dilemma between two projects. Then we'll pull out a really powerful tool called net present value to try and find a clear answer. But you're going to want to stick around because there's a twist that changes, well, everything. After that, we'll look at another way to measure this, IRR, before we finally figure out how to choose the right tool for the right job.
So, where do we start? Well, every great analysis kicks off with a really good problem. And ours begins with a decision that companies big and small face every single day.
So, picture this. Your software company just landed a huge new client. Awesome, right? The project is going to take about 3 years. But here's the big question. Do you outsource all the development work to contractors, or do you take on the massive challenge of building everything yourself, in-house?
Okay, so here are our two paths. On the left, we've got Project R. That's the outsourcing route. You can see the initial costs are way lower, but you're paying those hefty contractor fees every single year. Then on the right, you've got Project S, the in-house option. This one needs a huge upfront investment for things like equipment, and you've got higher staff costs year after year. Now, the interesting part is that both projects promise the exact same payout at the very end, a cool £1 million. So, which one is actually the smarter financial move?
To figure that out, we need a way to compare the money we spend today with the money we hope to earn 3 years from now. They aren't the same thing. And that's where our first tool comes into play.
Let's talk about net present value, or NPV for short. The core idea is super simple, right? A pound in your hand today is worth more than a pound you might get next year. Why? Because of stuff like inflation, risk, and just the opportunity to invest it elsewhere. So NPV is kind of like a financial time machine. It takes all the money you expect to spend and earn in the future and zaps it all back to today, telling you what that whole project is worth in present-day pounds. The rule is simple. A higher NPV means it's a better investment.
All right, time to crunch some numbers. Now, to do this, we have to make a really important assumption. We need to pick an interest rate to discount all that future money. We call this the risk discount rate. Think of it as the return we'd expect to get from other investments with about the same level of risk. It's not a fact, it's an estimate, but it's an absolutely crucial one. For this exercise, let's start with a 20% assumption, just like in the source material.
So we plug in all the numbers for Project R, that's the one where we outsource everything, and what do we get? The net present value works out to £46,759.
And what about Project S, the big in-house build? Well, its NPV comes in a little lower, at £40,405. So, case closed, right? Project R as the higher NPV. It's the obvious winner. Or is it? Well, this is where things start to get really interesting.
Yeah, this is where the whole thing gets turned on its head. Because our nice, clean answer, it all hinges on that 120% guess we just made. What happens if that number isn't quite right?
I mean, let's be real. That risk discount rate, it isn't some magic number handed down from on high. It's just an estimate. It's our best guess at what it costs our company to borrow money or what we could earn somewhere else. And if that guess is off, our whole conclusion could be completely backwards.
Okay, now this graph, this is the whole story right here. It plots the NPV for both of our projects across a whole range of different interest rates. The dotted line is Project R and the solid line is Project S. And you see that spot where they cross? That's the key. It's called the crossover point and it happens at about 16.8%. Here's why this is so important. It's all about when the money gets spent. Project S has that huge cost right at the beginning, so its value gets hammered by high interest rates. But Project R's costs are more spread out, so it's less sensitive. The bottom line, if our real risk rate is above that 16.8% crossover point, Project R is the winner. But if our rate is lower than that, the lines flip and suddenly Project S, the in-house build, becomes the more profitable choice.
So that crossover point just showed us a huge weakness in our first analysis. The answer completely depends on an assumption that we might get wrong. So you might be thinking, isn't there a better way? A metric that can give us a clear winner without us having to guess the interest rate? Well, let's bring in another tool, the internal rate of return.
So the internal rate of return, or IRR, flips the question around. Instead of starting with an assumed interest rate, it calculates the interest rate where the project just breaks even, where the NPV would be exactly zero. The easiest way to think about it is as the project's own internal built-in annual growth rate. So we run the numbers again, this time for IRR. And what do we find? Project R, the outsource option, has a higher IRR, around 25.25%. Project S is a little behind at 23.66%. So once again, all signs seem to point to Project R as the superior choice.
But hold on. This is what we might call the IRR trap. And the source material has this fantastic warning, and I'll just read it. The investor should always select the project with the higher yield, but this is not invariably the best policy. In other words, a higher percentage growth rate doesn't automatically mean more actual money in your bank account when all is said and done. Okay, so what is going on here? We have two tools, NPV and IRR. They both seem to point toward Project R, but we know NPV has this huge catch that can flip the whole thing around. So, how do we actually make a decision?
The key really is to realize that these tools are asking totally different questions. IRR asks, which project has a higher percentage yield, a better growth rate? The answer to that is Project R. But NPV asks a much more practical, real-world question. It asks, which project is going to create more actual, cold, hard value for our company, given what it actually costs us to borrow money? And as we saw with that crossover graph, the answer to that much more important question is, well, it depends.
So let's wrap this all up with a few key takeaways. First, and this is a big one, a higher IRR looks great, but it doesn't always mean a more profitable project in terms of actual cash. Second, because of that, NPV is generally a much better tool for comparing two projects head-to-head. Third, the best choice is super sensitive to that interest rate you assume at the start. Which brings us to the final, most important point. These financial tools, they're incredible guides, but they are not crystal balls.
And that's really the big lesson here. You know, the models and the spreadsheets, they're great. They can crunch the numbers and spit out an answer. But true financial wisdom, the real skill, is questioning the assumptions that are baked into that answer. The best tool you have isn't the calculator itself, it's knowing which questions you need to ask in the first place.